Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. The other day, I got this question, and I think it was an excellent question that we can all learn from. So today, I'm going to break down this question and then talk about how you should adjust your portfolio, if you should adjust it at all, especially in times like this. All right, so I will summarize the question. Y'all can see it on screen. I'm doing it from memory here. But essentially, you got somebody in their 30s that have a 70 to 30 mix. That means 70% of their money in the stock market, 30% is in bonds. And in a year like this, where the market is down 22% so far this year, doesn't it make sense to say, look, let me get out of the stock market a little bit. Let me go into bonds. Bonds are supposed to be safer. And then when things get better, I'm just going right back into my regular mix, get back into stocks, and really protect my money. Here's the thing. In theory, that would be perfect. But in practice, it is almost impossible to pull off. I'd say it was impossible. It's almost impossible to pull off. So I'm going to explain everything you need to know about it. Okay, so first, that 70-30 mix, we call this asset allocation. That is the technical term for it. And again, it's the mix between stocks and bonds. Now, in a normal year, right? In a normal year, you pick up an investing textbook. One of the first lessons they teach you to become a financial advisor is that you're supposed to have a mix of stocks and bonds. I like to call this brakes and pedals. Stocks are known to do well. Those are the ones that's supposed to get you 7 to 10% a year on average. Bonds are historically only going to get you 3 to 4, maybe 5 on a good year. And the way that this works is when stocks do well, bonds are okay. And then when stocks don't do well, bonds are supposed to do better. The reason is bonds are loans that are made between companies, or you and a company say, look, Walmart, I'm gonna loan you $1,000 every year. You're gonna pay me a coupon. We call it a payment. So let's say they pay you $10 a year for 10 years. And at the end of the 10 years, the maturity day is what we call that. They're gonna give you the full $1,000 back and say, look, Walmart been around for forever. I trust y'all. I see your balance sheet. Y'all know how y'all can pay the bills. I'm going to trust Walmart. So when the stock market is down, it's chaotic. People think, well, I can go and take my money out of here and go somewhere safer because I know Walmart's solid. They're good for it. I know I'm going to get my money back. That is what normally happens. However, 2022 is not necessarily a normal year. And that is because interest rates are moving. And when interest rates go up, bonds don't do well. And there are a few reasons for that. I can do an entire video on that one. So for example, take a look at this. You can see that right now, at the time that we're recording, the stock market as a whole, and that's the light blue line, is down 22%. The bond market is down 17%. That's not necessarily normal. Now, yes, bonds are performing better. Nobody wants to take a 17% loss. Okay, I get it. But that's 5% better than where the stock market is as a whole. So yes, if you could have timed this correctly, you would have lost less money, but it still would have been a loss here. However, here's the big thing. When you make these adjustments, or you consider making these adjustments, it is very difficult to figure out when you are supposed to make them and when you're supposed to move back and forth. For example, October, the Dow Jones was up 13%. It's the best month we have had since 1976. Nobody saw that coming. I didn't even see that coming. So imagine if you said back in March, which I think that was the time we all said, look, this year's probably not going to be great, then you would have taken your money out, put it in bonds, still would have been losing in this particular year, and then missed out on October, right? And missed out on a few other good spurts where the stock market took off. And then what now? Like, would you jump back in November? Because we think historically November through April, the market does tend to rise. That's hard to call. It's extremely hard to call. So that's one reason why I wouldn't necessarily move. If you are somebody that's in your 30s, I would actually stick to exactly where I am, because history tells us that the market is going to rebound at some point. The same reason why dollar cost average add money every single week is because I'm still relatively young. My knees don't say so, but I'm still relatively young, and I can start to continue to buy. And as the market starts to rise, I'm accumulating more shares. And usually, whether it's an 80-20, 70-30, even a 60-40 portfolio, you are still going to be in the best places to win. And it's, again, far too difficult to time out when's the right time to get in, when's the right time to get out, and make what they call a tactical asset allocation. And that's the moving and shaking back and forth. Those investors who tend to be passive, buy and hold, don't really make that many moves, those are usually the ones that do best. This is one of the reasons, and if you've watched the channel for a while, you'll notice I always say I make adjustments every 6 months. Okay, I make adjustments every 6 months, and that's just what I continue to do. And that's why, because I would not have predicted that October would have been the best month, right? Just would not have thought that. I would not have thought that today, at least the time I'm recording, the market would have been up 600 points this week after all the stuff we went through. Like, just there's no way. There's no way. I can't predict it. Nobody really can. So the best thing is to continue buying and continue holding on to the allocation that you have. So the next question you might be asking is, well, what should my allocation be? Right? Like, I don't know. How much should I have in stocks? How much should I have in bonds? There's one back of the envelope calculation. This is a rule of thumb. It is not a law. Okay. But one of the easiest ones is called the rule of 110. You take 110 minus your current age, and that's going to give you a percentage. For example, let's say that I'm taking 110. Let's say I'm 30, just to make the math easy. That's going to leave me with 80. That means that 80% of my money should be in stocks, and 20%, that's the money that's left over, should be in bonds. Okay? So that should be my allocation. And every year, I want to come back, or every 6 months in my case, I want to come back and make sure that I'm at 80-20. And that's my goal. This is what's called rebalancing. These are the adjustments that I make every 6 months to make sure that I have that right allocation mix. And the older I get over time, notice, because it's based on my age, it'll be 81, 85, or actually it'll actually go down. So it'll be, 79, 75, and eventually be 50-50. And now kind of time out there to a degree where I'm 60. And the older I get, the more in bonds I have, because bonds are supposed to be a lot safer. And generally they are. The reason, again, going back to my bike analogy, is the brakes metaphor, right? When I was younger, I didn't really need no brakes on my bike. I could fall, get up. I haven't broken any bones, and thankfully and hopefully I don't in the future. But I could take a hit. I could take a hit back in the day. I fall now, and it ain't gonna go so well, right? I fall at 50, 60, 70. Those aren't funny anymore, right? So you want to make sure you have more brakes and more protection at that point in time. So this is why you go back and rebalance and reallocate. I actually wrote an entire article about it for Business Insider on why you want to do it and how you can do it for your portfolio, in case you have any additional questions there. All right, so to wrap the question up, no, you don't want to move. I know it's not fun, especially when both asset classes, asset categories, stocks and bonds, are both down double digits. It ain't fun. I know. We're literally all in the exact same boat right now. But time and history has shown us that you keep holding, right? You keep holding. In fact, you keep buying, and you usually end up a lot better off. You also want to zoom out, right? So you guys saw the chart that I showed you a second ago. If you zoom out, I'm just going to hit 5-year here. You zoom out here, and bonds actually haven't done well for the last 5 years. It's actually down 14%, as you can see. Well, the stock market is up 43%. So if you're still investing in both, you're going to get an average somewhere in between the two, and you're going to be, usually pretty great and do quite well. So that is how you want to have stocks and bonds generally. And there may be somebody say, hey, well, why would I invest in bonds anyway if over the last 5 years it's down 14%? That's a fair point. I would also note that if you go back to the chart, you'll see that it really started to dip in 2022. Prior to that, it was actually quite solid across the board, where the gains looks like it was above zero. I'll say that. Right, it was above zero, anywhere between 7 to 9% over the past 5 years, if you exclude 2022. So that's the other thing there. So again, it still makes sense to have stocks and bonds. You want to adjust that at least once per year. I like to do it once every 6 months. And it does not always make sense to kind of jump in and jump out, because that timing is extremely difficult. The last thing I'll say about the timing thing is, remember this chart from JP Morgan. When you miss out on the 10 best days, you can cut your performance in half. And that's just 10 days, right? All of October, that was like 30 days. So imagine missing that, because the person who holds has an average return. I think it was 9. You guys see it on the screen, but I'm doing from memory here. It was 9.2%. And you miss 10 days, it goes down to like 5%. Right? And you miss 10, 20, 30, 40, that performance is shot, right? So usually buying and holding and just sticking with it for the long term is usually your best bet. All right. That is it for me. Hopefully that answered your questions. And yes, y'all, I do read these questions. Some people I don't know why people don't think I be reading these questions, but I do. It's actually me. Y'all see my daughter on the videos. She's not commenting. So yeah, it's me. I read these videos and I try and do the best I can to help explain the stock market and make things simpler. If you want to learn more on how to become a better investor, analyze different stocks, and just learn more and really learn everything that I can possibly teach you, then you want to make sure you join the members only. We do new videos every single week. All right, that's it for me. I'll talk to you later.